Hello options traders, welcome back everyone. I wanted to talk a little bit about using collars for credits. I've been talking to some of the longer term investors here, and a lot of them are using collars, which is a very good long-term strategy, but they tend to lean towards collars for credits. And the reason they do it is like so many other strategies I've talked about in these videos, where they think that credits are somehow better. Because yes, all things being equal, it would be nicer to receive a credit. But what they don't realize is they're paying for that credit in the form of a bigger downside loss. So let's take a closer look at why you have to be careful of using collars for credits. So as a quick recap, what is a collar? Well, again, it's primarily used by long-term investors, and it requires that you are long shares of stock. And then what you do is you buy a put. And this put option acts like an insurance policy. It limits the amount you could lose on those shares. However, puts cost money. And so to reduce that cost, you're going to sell a call. And that's going to help to finance the purchase of that put option. But when you sell that call, it then limits your upside potential. When you do these three pieces, long stock, long put, and a short call, your profit and loss diagram will be identical to a vertical spread. But as I always tell traders, and this is important, all of your strategies are about trade-offs. It doesn't matter if you're choosing different expirations, different strategies, different strikes. They simply create different risk profiles. And it's the same thing with debits and credits. Credits aren't better. Instead, they are just different. They create different sets of risk and reward. So should you use a credit? Well, it depends on the risk you're willing to take. Or we could just as easily say it depends on the rewards that you're after. So if you're willing to take bigger risks, yeah, you might reach for a credit trade. But if you're risk averse and really don't want to face those big downside losses, or you're after bigger rewards, you might need to reach for the debit spread. So let's take a look at why that happens. We're going to take a look at three different scenarios. I'm going to look at what's called a net zero trade, where we're not really getting a debit or a credit. Then we're going to look at the debit trade and the credit trade. So let's start with the net zero trade. And the net zero, as the name implies, means that we're not getting really a credit or a debit from these two options. So let's say we buy shares for 100 and we buy the $95 put. Let's say it's trading for $1.40. And so that's going to give me potentially 5 points of downside loss. Now to help finance this, I'm going to look for an option that's trading for about $1.40. And let's say that the 105 call is trading for $1.60. And this is going to be pretty typical. In the real world, it's going to be hard to find them trading for exactly the same amounts. Now in this case, I have them exactly 5 points away from the current stock price. So the call option is going to have a little bit higher price for the cost of carry. But in the real world, we'd say this is about a net zero trade. Technically, it's a net credit of 20 cents, but after commissions, who's counting? It's basically a net zero. If we put this on, our maximum gain is 520 and our maximum loss is 480. Now, how are these numbers coming up? Well, think about it. If I buy shares here for 100 and I have the potential obligation to sell them for 105, that's a $5 gain. That's the most I can make. But I also receive this little 20-cent credit here, so it actually makes my maximum gain 520. The maximum loss is found the same way. If I pay 100 for the shares and I buy the $95 put, that gives me a potential $5 loss. Because I purchased the shares for 100, I have the right to sell them for 95. That's a $5 loss. But because I received the 20-cent credit, that only makes my loss a maximum of 480. And if I do this trade, this is what my risk graph looks like. Again, very much like a vertical spread. Now notice, right here in the center at 0, this horizontal line right here shows that we're not making any gains or any losses. That's why it crosses here at 0. So our maximum gain is up here at 520, and you can see that it is limited. It flattens out up here. And the maximum loss is also limited down here at 480. But notice that the distance from these flattened portions on the blue curve compared to the red line right in here are about the same. In other words, 480 is about the same number as 520. And that is always going to be roughly true when you're doing a net zero trade. You're going to have equally sized gains and losses. But now what happens if we do a credit trade? Well, let's take a look. In order to get a credit from this strategy, there's one of two things that we need to do. We either need to decrease the put strike or decrease the call strike. Or actually, I could do both, but I've got to do at least one of those. And if I decrease the put strike, it's making that put cheaper. And therefore, I'm getting more towards a credit or a bigger and bigger credit. I could also reduce that call strike, which is making the call more expensive and therefore adding to that credit. So let's say that we buy shares of stock again at 100, and now let's decrease the put to 90. I'm going to buy the 90 put, let's say it's trading for 40 cents. I'm also going to decrease the call strike from 105 that I had before down to 100. And let's say the $100 call is trading for 350. Now look at what's happening. Now I've got a net credit of $3.10. That's just the credit from these two trades. I've received $3.50 from the sale of the call. I'm taking some of that money, down here 40 cents, and buying that put, and that's leaving me with a $3.10 remaining credit. So remember, you're free to choose these strikes. We can make them a net zero, and as I'm showing here, you can also make them a net credit. But to do that, you have to decrease the put strike and or that call strike. So if I do this trade right here, my maximum gain is now 310, and my maximum loss is 690. And those are found in a similar way. If I buy shares for 100, and I have the obligation to sell them for 100, I can't make any money. But I do keep this credit for 310. So my maximum gain is 310. If I buy shares for 100 and I've got the right to sell them for 90, now that's a $10 potential loss. However, again, I keep this 310 credit. So a $10 loss matched with the 310 credit gives me a potential 690 maximum loss. So if I put this trade on right here, this becomes my profit and loss diagram. Once again, notice here is the zero line. Take a look at the kind of the imbalance that's going on here. I've got a maximum gain of 310, but now I've got a maximum loss of 690. Take a look at that blue curve right there. The entire curve is shifted down on both ends. This is what happens when you go for credit trades. And again, it's not saying it's bad. It's just that most traders, when you ask them, why are you doing a credit trade? Well, it's because I'm afraid of losses. And I figure the bigger the credit that I get, then the better off that I am. And they don't realize it's just the opposite. The credits are opening the doors for bigger losses. Okay, now let's take a look at the net debit trade. What happens if we do a debit? Well, there's one of two ways that we get a debit trade. We have to either increase that put strike or increase the call strike, or I could do both. So let's say we buy our shares at 100, and now I'm going to buy the $100 put. I'm going to increase it from 90 up to 100. And now it might cost me $3.35. Let's say I also increase that call strike, and I'm going to sell the 110 call. Now I'm not going to get as much because that strike is further away from the current stock price. So let's say it's trading here at 63 cents. So the net debit between these two prices right here, $3.35 and 63 cents, is an overall debit of $2.72. And if we do this trade, my maximum gain is now $7.28, and the maximum loss is now $2.72. So where are these numbers coming from? Well, if we buy shares for 100 and I have the obligation to sell for 110, the most I could make is 10. But I also paid $2.72 for this debit. And so that means that my overall maximum gain is now reduced to $7.28. What about the maximum loss? Well, again, if I buy shares for 100 and I have the right to sell them for 100, there's no gain and no loss. But I still have to account for this $2.72 debit, and so therefore the maximum loss is $2.72. So when we do a debit trade, we're really more risk averse. We're more after that insurance policy. We want to pay for that put because we don't want the big downside loss. And this becomes our risk graph. So again, notice that our zero is right here, but look at what it's done to my profile. I've got a maximum gain up here of $7.28 and a maximum loss down here of $2.72. Overall, this entire blue curve is shifted higher. This is the effect of using debit trades. So as I said before, don't think of debits and credits as good or bad. They're simply different. All you're doing is you are shifting these graphs up and down. If you want them to shift higher, in other words, smaller losses and bigger gains, then you have to use debit trades. But if you're willing to take the bigger losses and or settle for smaller gains, then by all means, use the credits. So remember, with the credit trade, there's nothing wrong with it. But what makes it wrong or what makes it dangerous is that traders usually believe that the credit makes the trade safer, and the credit actually equates to greater risk. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.